This is Quent Bila with a continuation discussion of job order costing. We'll be focusing on the manufacturing overhead cost component of production cost. Its accounting is different from direct material and direct labor cost assignments to production. It can result in an account imbalance that is dealt with at year end. We'll also prepare entries for completed jobs which are subsequently sold. So the third manufacturing cost element is factory overhead. It accumulates a variety of actual indirect costs, but progresses those costs out to production on an estimated basis. Therefore, at year end, there's what's called an under or over applied value overhead in this account. It's important that you see all the cost flows for production and master the journal entries that carry out cost movements during a period. Here's an overview you've seen before. We already talked about the accumulation stage, which populates all the manufacturing cost elements with actual costs incurred, raw material purchased, factory labor paid, and all overhead costs incurred. Those are examples 1 through 3. This then leads into the assignment stage, entries 4 through 8, where production that is being made receives its costing, debit entries, starting with the work in process account and moves to the finished goods account, and then ends up in the cost of goods sold. Now, note that the use of raw material consists of those that can be directly traceable to our product and raw material uses that cannot be physically traced into the product. The latter is called indirect materials. The example above has the company consuming $30,000 of raw materials, of which $24,000 are direct and cost to work in process directly, and the other $6,000, which are indirect materials, can't be traced to the product and must flow through the overhead account first. Ditto for labor. Total paid of $32,000, $28,000 of which is directly traceable to assembly of the product. The other $4,000 is indirect labor and must flow through the manufacturing overhead account as well. The assignment is the term used by the textbook which describes the movement of costs starting with a work in process account, moving through finished goods, and finally cost of goods sold. We'll look at the accumulation stage of manufacturing overhead, then moving with certain overhead dollars into work in process. We'll call that applying overhead to production. We don't use that term for direct material or direct labor. We'll do that by the use of a predetermined formula using estimated dollars. This is a progression of a cost element that cannot be demonstrated by observable events such as direct requisition of materials, etc. Manufacturing overhead is more complex in the accounting. We can't trace its content in our product. So our objective is to assign manufacturing costs to work in process inventory. We increase work in process with debits and decrease our accumulated account with credits. Raw materials that are traceable to products are moved directly to work in process, ditto for labor, but for overhead costs, they'll be moved via an estimate established at the beginning of the year. Here's a T account or overhead account. Actual dollars come in representing indirect materials, indirect labor, and other manufacturing costs such as depreciation, etc. And we move manufacturing overhead costs out, called applying dollars to work in process inventory. Estimated dollars come out. All indirect costs are accumulated as debits when incurred, increasing the manufacturing overhead balance. As indirect materials are requisitioned, such as lubricants, they come out of raw material accounts and go into manufacturing overhead. As indirect labor is transferred, such as janitorial labor from factory labor accounts, they go into manufacturing overhead. Plus, there are other indirect costs are recognized, such as plant manager salary, depreciation, etc. Our job cost sheet progressively summarizes costs both being assigned and applied to a particular job being worked on. From all those cost sheet totals, journal entries are then made in a ledger. Manufacturing starts with obtaining raw materials that require conversion. The raw materials that can be directly traced to our physical product are called direct materials and are directly assigned to the job and work in process inventories increased straight away. Likewise, as labor tickets are examined, that labor, which is directly responsible for making the product, is identified and directly assigned to the job and work in process is increased straight away, called direct labor. However, overhead costs in the plant cannot be directly traced, cost by cost, into our product. These costs either can't be directly observed or directly measured. We will cost our product out with estimated bundles of overhead. This costing is very different compared to direct material or direct labor. The nature of these costs is that they benefit the entirety of our plant, not just one specific job. Indirect material can be measured as they are requisitioned out of stock supplies, but because they are not directly traceable to our production job, we will accumulate them in an overhead account first. Imagine the grease that lubricates production machinery. This can be stored in a raw material account before it's used. When maintenance personnel requisition a quantity of it, such as a 20-pound container, they will use it to sustain the smooth operation of all the machinery in the plant. The grease won't appear in our finished product, but it facilitates the making of it. So some part of that cost will be allocated to the jobs that are being worked on during the period, an indirect raw material cost. Ditto for indirect labor, such as the janitorial crew of the plant. This labor type keeps the entire plant in a clean fashion to facilitate all of the production efforts. These indirect labor costs will be collected first in a manufacturing overhead account. There are also other overhead cost elements beyond indirect material and indirect labor. The depreciation expense of the building and equipment in the factory are examples. As incurred, they will be collected in an overhead account. Our manufacturing overhead account will collect or accumulate all these indirect costs as the account is debited. Indirect materials, indirect labor, other overhead. And periodically, these bundled costs will be applied to individual jobs, reducing the overhead account and increasing the work in process inventory account. These bundled costs use a budgeted rate calculated at the beginning of the year. That rate carries a slice of dozens of indirect costs as jobs are costed and the work in process account increased for the overhead element. Picture, if you will, a slice of fully loaded pizza. All the toppings could be considered individual indirect costs being brought to our job cost sheet via the bundled overhead rate. To summarize, actual costs of direct material are directly assigned to jobs. Actual costs of direct labor are directly assigned to jobs. But estimated dollars of manufacturing overhead are applied to jobs via a bundled rate which allocates various indirect costs of the plant. The actuals of direct material and direct labor go direct to work in process, and actual indirect material and indirect labor flow through manufacturing overhead control account first. So while actuals flow into the manufacturing overhead control accumulation account first, estimates flow out on a costing basis. Can a disconnect or imbalance then occur in this account? Yes, and we'll look at that shortly. Moving material usages, both direct material and indirect material, are on an actual dollar basis. Work in process is increased with debit actuals. Manufacturing overhead controls increased with debit actuals. And the raw material inventory accounts must then be reduced with a credit. The actuals transferred from the raw material accounts must be accounted for in work in process and manufacturing overhead. Ditto for factory labor. Moving factory labor usages, both direct labor and indirect labor, are on an actual dollar basis. Work in process is increased with debit actuals. Manufacturing overhead control account is increased with debit actuals. And the factory labor control account must then be reduced with a credit. The actuals transferred from the factory labor control account must be accounted for in work in process and manufacturing overhead. The actual spending for both materials and labor is transferred. It's based on its traceability to jobs. Whether it's traceable or not, work in process takes direct charges for traceable items, or indirect materials or indirect labor are routed through manufacturing overhead first. All indirect costs flow through the manufacturing overhead control account. And when costing our product with overhead, we are moving applied dollars. We're moving estimated dollars. The work in process account is increased with estimated applied overhead dollars, and the manufacturing overhead control account is reduced with those estimated applied dollars. The estimated dollars are transferred from the manufacturing overhead control account into work in process inventory. As mentioned, overhead costs are not directly traceable to individual jobs. We cannot see or document these individual indirect costs to our product. Consumed materials and labor which are traceable to our product are assigned directly to the work in process inventory account. Indirects for both of these elements are routed through the manufacturing overhead control account. Estimates going out of the overhead account are applied to jobs, and the work in process inventory account is increased. So if the manufacturing overhead account incurs actuals coming in and estimated applied dollars are going out, we'll have a balance remaining in that account. So the overhead account will have incurred actuals as debits coming in and estimates removed for costing purposes, credited. There will be some balance in this overhead account. What is this remaining balance called? If the estimated applied overhead moved to work in process inventory account as our jobs are costed is less than the actuals coming in, we call this an under-applied overhead. The balance is higher in the actual debit column. If the estimated applied overhead moved to cost our jobs is more than actuals coming in, we call this over-applied overhead. The balance is higher in the applied credit side. If our estimates removed for costing purposes are credited for $23,000 overhead, yet our actuals incurred are $25,000, we'll have an underapplied manufacturing overhead debit balance which remains. $2,000 debit balance will remain in the account. This means we have undercosted our production and have remaining actual dollars not yet applied to jobs. Likewise, if our estimates removed for costing purposes are a $21,000 credit to the overhead account, and we incurred only $20,000 of actual, we'll have an over-applied overhead credit balance. A $1,000 credit balance will remain in this account. This means that we have overcosted our production. We have removed more applied dollars to jobs than actual dollars incurred. Either condition at year end needs to be addressed. We cannot close out the year with a balance in the control overhead account. If we have an underapplied debit balance in this account, what's required is a credit to it to zero it out, and the offsetting debit entry is commonly an adjustment to the cost of goods sold account. That is, adjusting for the previously undercosted jobs that were sold, by now giving a debit increase to the cost of goods sold account. If we have an overapplied credit balance in the overhead control account, a debit is required to it to zero it out, and the offsetting credit is commonly an adjustment to the cost of goods sold account. That is, adjusting for the previously overcosted jobs that were sold. We're now giving a credit or reduction to the cost of goods sold account. Some companies more sophisticated about disposing of the over or under applied balance could apply it to adjusting the ending work in process inventory, adjusting the finished goods inventory, and the cost of goods sold also as adjustment. Each of those areas have a labor or material content in them and could be adjusted for the over or under applied overhead. The mechanics of this sophisticated adjustment are beyond the scope of this course. However, we never adjust the raw material account for any over or under applied overhead. Let's look at how we can move estimated dollars into work in process for overhead. Now, manufacturing overhead relates to production operations as a whole. It's a large variety of factory costs other than direct material and direct labor. We cannot assign these to specific jobs as actual overhead costs are incurred. Remember, the grease we requisition is not specific to a particular job. That's why companies assign overhead to work in process and to specific jobs on an estimated basis to the use of a predetermined overhead rate. Let's picture what's happening here. Again, overhead relates to production operations as a whole. A large variety of factory costs, I might call them toppings on pizza, other than DM or DL. We need a vehicle or rate to deliver slices or fractions of that bundled universal cost to individual jobs throughout the year. So each job gets a share of all the topping costs by use of the predetermined overhead rate. How do we calculate this predetermined rate for overhead? Well, first, it's based on a relationship between estimated annual overhead costs and expected annual operating activity. The annual operating activity is expressed in terms of an activity base. Companies have to search for the best base they can that they can measure from actual jobs and then use to apply manufacturing overhead dollars. This could be the use of direct labor costs or direct labor hours as the base. Every job's going to have those elements. Or it could use machine hours that can be measured as jobs progress, or any other activity that is an equitable base for applying overhead costs to jobs. This predetermined rate is established at the beginning of the year. It's budgeted. Small companies often use a single company-wide predetermined overhead rate. Larger companies often use rates that vary from department to department. For this course, we'll just use one single activity base. The formula for a predetermined overhead rate is as follows. Estimated annual overhead costs divided by expected annual operating activity, whatever base is selected, equals the predetermined overhead rate for the year. Let's look at an example. Let's see how this plays out. We need to assign to work in process inventory overhead costs during the period to get a timed information about the total cost of a completed job. The activity base selected must be able to be measured as it's used by specific jobs. It's actually tracked by each job. We take a measured activity base, multiply it times the predetermined overhead rate that's budgeted, and we come up with dollars assignable to each job for overhead. That's summed, and we put that debit in work in process. Again, job cost sheets have to be kept in sync with inventory ledger accounts. Now, what does a company want to happen? Well, they desire that the total expected annual activity base, labor hours, machine hours, whatever chosen, that's used in the beginning of the rate calculation will indeed come close to the actual activity base used when making all the jobs during the year. Ditto for estimated annual overhead dollars. If these two factors are reasonably projected accurately, the overhead rate assigned during the year will approximate the overhead actually incurred by the company. Let's take an example. Wallace Company uses direct labor cost as the activity base. Assuming that the company expects annual overhead costs to be $280,000 and direct labor costs for the year to be $350,000, remember, this is the activity base. It's forecast for all jobs expected to be worked on. Let's compute the overhead rate as follows. $280,000 expected overhead cost divided by $350,000 expected activity base equals 80%. What does that mean? For every dollar of direct labor incurred by individual jobs throughout the year, Wallace Company will apply or assign 80 cents of manufacturing overhead to a job. That's the predetermined overhead rate. That 80 cents of each direct labor cost is the slice of pie that carries all our components of manufacturing overhead. Now, let's assume during a time period that actual direct labor costs incurred were $28,000 on various jobs. How much overhead are we going to allocate to those jobs? We take our activity base of $28,000 times 80%, or $22,400. So the activity base is the measured direct labor cost. Our rate, 80%. We come up with our overhead to be applied to those jobs. Here's the journal entry to record this application. Debit work in process inventory, $22,400 to increase it. Credit manufacturing overhead, $22,400 to decrease that. These are estimated dollars. These are estimated dollars to be moved out of the overhead account into work in process inventory. The source document for allocating overhead to our jobs is the predetermined overhead rate times the direct activity base. Each job's measured use of the activity base, direct labor cost in this example, drives the overhead allocated to each job. To take job 101 as an example, on January 10th, they incurred $9,000 of direct labor costs. To that, we allocated 80% or $7,200 manufacturing overhead to job 101. On the 31st, job 101 used $6,000 of direct labor costs. We allocated 80% of that number, or $4,800 overhead to that job. So the total overhead allocated to jobs during the month of January, $12,000 for job 101, $7,200 for job 102, and $3,200 for job 103 become the basis for increasing our work in process inventory, $22,400 at month end for overhead allocated. The balance in the work in process inventory accounts should equal the sum of all costs shown in the job cost sheets. This is a must. All the job cost sheets for unfinished jobs at the end of January total $74,400 for jobs 101, 102, and 103, and that's in sync with the debit and work in process for direct material, direct labor, and manufacturing overhead, $74,400. Review question. The formula for computing the predetermined manufacturing overhead rate is estimated annual overhead cost divided by an expected annual operating activity expressed as direct labor cost, direct labor hours, or machine hours, or any of the above. Any of the above. Any of these bases could be an operating activity selected as the vehicle to move allocated overhead dollars into our individual jobs. Remember, indirect costs are not traceable to the finished product. We can't directly observe the association like requisition direct materials or the use of direct assembly labor. But overhead is a cost component to keep the entire factory intact and operating smoothly. So companies try to find some activity base that can be measured for each job that carries a predetermined formula of overhead costs to the product. It's a best guess estimate. There's not an exact science for allocating overhead costs. Now, when a job is complete, the company will summarize the cost and complete the job cost sheet. So we have $39,000 for job 101 is complete. What journal entry are we going to make? When it's finished, the company will make an entry to transfer its total cost to the finished goods inventory. It will debit finished goods inventory $39,000 to increase it, and to remove cost from work in process inventory, credit that for $39,000. The T accounts below show this transfer of costs. This is the equivalent of a cost of goods manufactured number. The product is complete, move it out of our WIP inventory, and move it into finished goods. Those costs represent a combination of actual direct dollars and estimated overhead dollars. To continue our illustration, let's assume those goods are sold. So on January 31st, Wallace sells on account job 101. The job cost $39,000 and it's sold to a customer for $50,000. The entries to record and recognize cost of goods sold are as follows. Now this assumes that we're on a perpetual inventory system. That is, we determine cost of goods sold when the product is sold. We don't wait till month end. Entry on date of sale. Debit accounts receivable, $50,000. This is a credit sale. Credit sales revenue. This is our revenue entry for retail pricing. Then we debit cost of goods sold, $39,000, and we credit finished goods inventory, $39,000. We reduce the inventory account and move those costs into cost of goods sold. This cost entry removes the cost of the asset given up. Question. In M Company, job number 26 is completed at a cost of $4,500 and later sold for $7,000. A correct entry includes which partial information? Consider this carefully. The only partial entry below which is correct is C. Debit finished goods inventory, $4,500, and credit work in process inventory, $4,500. This is an entry to record the completion of the job and moving into finished goods inventory. Why the other answer is incorrect? A is incorrect because, while that's a COGM entry, we need to use cost and not retail price to move it into finished goods. B is a correct entry for cost of goods sold recognition, but we have to use cost, not retail. And D is incorrect because the transaction is a cash sale, not a credit sale. This was a very tricky question. Any combination of accounts and journal entries would be correct. It's the values that would be incorrect. Let's work another example. During the month, Onyx Corporation completed job 109 and job 112. Job 109 cost $19,000 and job 112 cost $27,000 in total. Job 112 was sold on account for $42,000. Journalize the entries for the completion of the two jobs and the sale of job 112. First, the completion of the jobs. We have to move it out of work in process and move it into finished goods inventory. We'll debit finished goods inventory, $46,000, the cost of both jobs, increasing that account, and credit work in process inventory, $46,000. Again, the completion of both jobs, a summary ledger entry. The sale of job 112, sold on account, debit accounts receivable, $42,000 retail price, increasing that account. Credit sales revenue, $42,000. Debit cost of goods sold, $27,000. Credit finished goods inventory, $27,000. Both these entries are paired in a perpetual inventory system. The retail, the revenue entry first, and the cost entry second. A quick interpretation of that entry: we gave up an asset costing $27,000 and received an asset valued at $42,000. As measured in our income statement, sales revenue increased by $42,000, cost of goods sold and expense $27,000 debit. Our gross profit on the sale, $15,000. Assets increased by $15,000 on the left-hand side of our equation. And our income statement is picking up a $15,000 gross profit in the income statement on the right-hand side. We were doing cost accounting entries for a manufacturer. This just reminds us that service companies can also use cost accounting because they need to track the cost of certain jobs. So the same principles can be used in a service company. What are the advantages of job order costing? There's a more precise assignment of cost to projects than process costing, which we'll cover in the next chapter. It provides information to determine the profitability of specific projects. What's the disadvantage of it? It requires a significant amount of data entry. Here's another example of a cost of goods manufactured schedule. Remember, this is all about the WIP inventory account. And this reminds us that manufacturing overhead comes in on an applied basis, not actual overhead costs. The applied overhead, which is an estimated number, is added to the actual direct material and direct labor costs to determine total manufacturing costs for the period, TMC. You can see in this schedule the base formula, beginning balance of work in process, all additions to it during the month, 74.4 TMC. Get a subtotal, subtract out the ending work in process, and we force out the cost of goods manufactured, $39,000. Yes, that's what's subtracted from the work in process account. Here's a partial income statement for the company. It calculates the cost of goods sold, which is all about changes to the finished goods inventory account. Again, the base formula to force out cost of goods sold. Beginning inventory plus additions, which is COGM. Subtotal, subtract out ending finished goods, 0. So the cost of goods sold is the full amount of the additions because there's no ending inventory. A review comment on under or over applied manufacturing overhead. We saw that a debit balance in the manufacturing overhead control account means that overhead is under applied. The estimated assigned dollars were less than the actual incurred dollars. Production was under costed. And a credit balance in the overhead control account means that overhead is over applied. The estimated assigned dollars of overhead were greater than the actual incurred. Production was over costed. These imbalances are due to the fact that we have actual dollars coming into the overhead control account and estimated dollars coming out. And a year-end balance in the overhead control account is eliminated by adjusting the cost of goods sold for the period. That is, under-applied overhead is debited to cost of goods sold. Over-applied overhead is credited to cost of goods sold. They're both catching up on the errors that occurred in effect in costing the product as it was made. The statement at the bottom tells us that conceptually that balance could be allocated among the ending work in process, ending finished goods, and the cost of goods sold account itself, because all those accounts have progressed dollars into them, and the over or underapplied overhead is an adjustment of those progressed dollars. This chapter does not illustrate this more sophisticated settlement of the balance in the overhead account. Here's an example of a year-end adjustment to the overhead control account. At year-end, the Wallace Company has a $2,500 credit balance in it. We need to adjust it and eliminate it. Here's the journal entry. Debit manufacturing overhead, $2,500. That will reduce that account to zero. Credit cost of goods sold, $2,500. In effect, the credit balance in the overhead account has been transferred to cost of goods sold. Question. Manufacturing overhead is underapplied if B, the actual overhead is greater than the applied overhead. The applied overhead entry is what costs our product. If that's less than the actual overhead, our costing was underapplied. Our costing as production was made used rates that were insufficient to fully account for the total actual dollars in the overhead account. As an example, if we removed 80 for costing purposes, but we incurred 100, we're $20 underapplied. Here's an example of us needing to apply overhead during the month. We're given that the predetermined overhead rate is 140% of the direct labor cost. So the direct labor cost is the activity object chosen to allocate overhead dollars to our product. So during the month, our company incurred $90,000 of factory labor costs, of which $80,000 is direct labor and $10,000 is indirect labor. So note again that our activity base is the direct labor portion of that total labor cost, $80,000. Actual incurred overhead during the month, $119,000. So let's compute the amount of overhead that we're going to apply during the month. We'll also determine if the amount was under or over applied. First, the overhead applied, 140% times the activity base of $80,000 direct labor incurred. We need to allocate $112,000 of overhead. The actual overhead was $119,000. We applied or took out $112,000 of the account. That leaves us with a $7,000 underapplied manufacturing overhead for the month. The actual incurred overhead was greater than the applied overhead to our jobs. That will generate an underapplied imbalance in the overhead account during the period. It'll have a debit balance remaining. We underapplied the overhead in our costing process.